Right, so tomorrow Bank of Canada is going to raise another rate hike, most likely by 25 basis points, and it's pretty much priced in. And this will push up the overnight rate to 5% and the prime rate above 7%. So this is the highest level of rate we have seen in the last 2 decades. So this is a significant move, guys, okay? A lot of mainstream economists and the Twitter warlords are predicting that the rate will cut sometime next year. Previously, they said the rate will cut down this year. Now this is not looking like it's going to happen. They're predicting that the rate will cut or Bank of Canada will start cutting rates sometime next year. I have a thesis where I believe that the era of low interest rate has gone, right? And in order to understand, we have to look into the history, because if you talk to a financial advisor or if you listen to a financial traditional mainstream media, you will see a narrative being played that the global debt has reached $300 trillion and there is so much debt in the system, especially the governments like federal government in Canada and the US have taken a lot of debt, and for them it is better to keep the rates low so that they can still paying interest and taking on more debt. If we look at the history, we see that the credit cycles are repeated in specific patterns. So when I say credit cycle, means if you have to look into the benchmark of all the interest rate, which is considered as US 10-year treasury yield. If you look at that and you span across a century, you will see that interest rate has actually moved up and down in a specific pattern, because a lot of typical mainstream media analysts and economists and the financial advisor, they actually look at the last 10, 20 and maybe 30 years to conclude their theory in terms of where the market is going to head in the next future. And my thesis is that in the last 10, 20, 30 years we haven't seen the repetition of cycle from that perspective. So when I say that cycle, you have to look into the interest rate over a 80-year period. So when you look at that, according to this chart, you will see that the interest rate has gone up from bottom to the top, and then now it has come down from top to the bottom. So during the pandemic, we have seen the interest rate has touched the bottom, which is pretty much zero bound. And from that zero level, now it is going up. So we may not go back to that level anymore. And most likely, over the period of 10, 20, 30 years, or maybe 40 years, we will see a similar upward trend, and it is going to hit another peak over that period of 40 years. So it's a 40-year cycle we have seen from 1940s to the 1980s, when the interest rate were typically at the same level as we have seen during the pandemic, like sub 3%, and then it has gone up to like 15% when Volcker quote unquote killed the inflation, and then from that point it has been trending downwards consistently over a period of another 40 years, and then we saw the bottom in 2020 pandemic era. So what is the reason? So let's compare the two dynamics. In 1940s, the US government, if we take that example, they have taken a lot of debt. They have done a lot of fiscal spending, and all of that spending was going into war, okay? But there is a big difference between then and now, because now the governments are basically doing fiscal spending not only to fuel a war, but to cover the expenses. So in 1940s, the war was a limited event. So it has a time limit where if the war stops, then of course the spending will stop as well. And then after that, there was a big reconstruction happen, which actually produced a lot of goods and services. And also we saw a massive influx into the workforce in the form of women. And that actually contributed the workforce and productivity growth, which actually contributed in terms of the GDP numbers. So that 1940s makes sense the way we saw the overall economic growth, and the interest rate was going up along with that, because the inflation was going up and then they wanted to control that. From 1980s all the way to 2020s, we have seen a massive growth in those 40 years. Again, we were seeing that the interest rate was climbing down, and the governments and the corporations and everybody was actually levering up in order to produce goods and services in the economy. So that was the recipe of success in the last 40 years, where everything was actually built around debt, because they know that the interest rate in the long run is going down. So the new debt is going to be cheaper compared to the previous debt. So that's how the whole system was kind of working, where the companies and the governments were taking new debt, which is cheaper, to pay off the previous debt and basically keep piling up debt to lever them up and then produce goods and services. Now we have seen that cycle has ended in 2020. We have seen the interest rate has hit the zero bound bottom layer. From now here, it is likely to go up. Okay, now this will not happen over a 6 months period or an yearly period. It will happen over a decade, 2 decades, 3 decades, or 4 decades, just like we saw a 40-year cycle. What will happen to the global debt? Well, there could be two possibilities. Number one, either these governments will continue to print money to inflate away the debt, which means they will keep printing money to pay off the previous debt. The way they're going to do that most likely is going to use yield curve control. So yield curve control allows government and central banks to target specific level of yields on the interest rate, which will allow government to take advantage of the cheap money that they can get from the central bank, but they will still let the commercial banks running a higher interest rate from a consumer spending perspective. So they can still control the consumer markets with the higher rates, but still let government to take advantage of the lower interest rate borrowing from the central bank. The only downside is this will debase the currency. For the US, it may not matter because they have global reserve currency status, but for a country like Canada or Australia or European country, this will debase their currency. So that's the downside of it. But that way they can deleverage themselves, paying off, getting more debt, which is cheaper, and then pay off the previous debt. That could be one scenario. The other scenario is if they actually default on their debt obligations. So when it happens, it could be a debt jubilee where they say, okay, the whole debt is going to be evaporated and we will start again from the scratch. And then that could be a possible scenario as well, but that will require a lot of political consensus, and it will actually wipe out a lot of wealth in the system as well. So that's less likely compared to the first option, where I say they can inflate away the debt. Using YCC, they can suppress the interest rate for the government, but the commercial banks will continue to charge higher interest rate because they want to be profitable in a high inflation environment where they have to raise the interest rate above the inflation rate. So that could be those two scenarios in the future. And if we look at that in a grand scheme of things, we will see the interest rate from a consumer perspective is likely to go up. Again, this is just my hypothesis. By looking into charts and the history, could be wrong. This is just me kind of sharing my analysis with you. You let me know what you think in the comment section, challenge my narrative as well, and let me know where I fell short. Provide your thesis as well. And if you like the video, give me a thumbs up, subscribe, and I'll see you in my next week video. Thank you.